There is a massive, invisible machine operating entirely in the dark. Right now, it is consuming nation-level electricity and capital, expanding rapidly without any ceiling. Before we look inside the financial ledgers of this machine, take a second to like this video and subscribe to the channel. The artificial intelligence industry is currently characterized as a limitless technological gold rush, promising to generate massive wealth through a new kind of computational intelligence. However, OpenAI's 2025 audited financials show the company lost $38.5 billion in a single year. This chart tracks internal projections. By 2029, OpenAI expects annual losses to reach $44 billion. Compare that burn rate to historical tech startups. During the dot-com boom, the heaviest corporate losses were a tiny fraction of the capital required today. A company losing nearly $40 billion a year creates a deficit so large it raises a specific question. If the company isn't paying its own way, who is? Economists call this an externalized cost. It occurs when a corporation avoids a massive operational expense by forcing unconsenting third parties to pay the bill. Training large language models requires brute force computational power. That work happens inside a massive physical infrastructure of high-density server racks. The International Energy Agency reports that the electricity needed to run this hardware is on pace to double by 2026. This cube represents the total electricity usage of the entire country of Japan. The identical block materializing next to it is the projected energy demand for AI, a single privately owned sector matching the power draw of a global industrial nation. Big tech firms do not operate their own independent power grids. Instead, they are attempting to pass these immense infrastructure and electricity costs directly onto local utility ratepayers. Beyond the electrical grid, the models themselves rely on another externalized expense, the data used for training. This typically involves scraping billions of words and images from the open internet without compensation. The copyright lawsuit led by the New York Times highlights this practice. It alleges that tech companies effectively externalized their research and development costs by simply taking copyrighted material to build their commercial products. Viewed this way, the AI industry is not currently generating vast amounts of new capital. It is transferring existing wealth from public utility grids and independent creators directly to big tech balance sheets. This aggressive financial strategy is driven by a growth-at-all-costs philosophy that has become standard across the technology sector. This engineering culture was built by the same organizations that pioneered modern digital advertising: Google, Meta, and Amazon. In that environment, the primary objective is user retention and conversion, often treating transparency and ethics as obstacles to speed. This priority was signaled clearly when OpenAI disbanded its long-term risk team, choosing to accelerate product releases over maintaining internal safety oversight. Following that shift, co-founder Ilya Sutskever left the company to create Safe Superintelligence, a new venture established in direct opposition to OpenAI's current trajectory. Researchers use the term existential risk to describe the potential for artificial general intelligence to create hazards that scale to the level of humanity itself. When corporations dissolve the teams designed to mitigate those hazards, they effectively pass the existential risk from their private boardrooms onto the general public. Big tech is currently subsidizing its commercial hype cycle with public utility money and scraped intellectual property, while gambling with the safety of the public. When you examine the scale of the debt and the physical resources required to maintain it, AI begins to look less like an industrial revolution and more like a debt-fueled credit cycle bubble. These astronomical burn rates and the speculative fervor mirror the financial mechanisms that drove the dot-com crash and the 2008 housing collapse. The industry heavily markets an efficiency scam, promising that future software will eventually solve the structural deficits it is creating today. However, a business model that relies on infinite growth, unpaid data, and subsidized public energy is mathematically destined to collapse under its own weight. We must ask what happens when the architects of this technology finally reach their goal, having sacrificed every ethical and financial constraint to get there. Tell us what you think in the comments. Is this market a bubble destined to burst, or a necessary breakthrough worth the risk? The bill for the future is coming due. if we refuse to recognize the externalized scam, we will be the ones forced to pay it.